Hello and welcome to this special interview here on Money Paathshaala. Joining me today is someone who's been a researcher for more than 10 years. People I usually stay away from. At the same time, he's someone who's a very popular blogger. He is very interested in behavioral finance, which I think is so very important for all of us to understand. Arun Kumar, who's the vice president and head of research at FundsIndia, which was among the first to actually bring online buying and selling of mutual funds with advisory into this country. Thanks very much, Arun. Pleasure talking to you. Keep following your posts and your research. They're very fascinating. Today, of course, I have more specific questions about mutual funds. And, since you are a research person, obviously your research is based on data, based on your analysis. So my first question, time and again, the conversation that keeps coming up is, are equity funds, and I'm talking now about active equity funds, are they outperforming their benchmarks? And of course, this keeps changing from, bull cycle to a bear cycle. But as of today, especially since, again, there is a sense of interest, with the market rising, what is your own reading? Are they outperforming their benchmarks? Do you advise an active mutual fund for a retail investor?
Sure. So, thank you so much, Vivek, for having us on the show, and super glad to be here. Let me take a step back in terms of how we look at this whole active versus passive spectrum. The evidence globally is super clear. Right? It's passive, clearly winning over active, be it US, be it Canada, be it Europe, be it Brazil. So you're seeing that there is a very clear evidence. Now the first question is, why is this happening? So there are three things. One, over a period of time, there are only two, or not just over a period of time. I think there are only three edges that any fund manager has in order to outperform. So one was the informational edge. So that is more or less taken away because everybody gets every information on their own. Maybe in very small pockets on the small cap space where the companies are very small, you may still have some informational edge. But broadly, at least for the large caps, it's almost zilch. Everybody gets the same information. So that edge is no more there. And that's the first problem. And then the second edge probably you can have is you analyze it better. So you have better tools, you are well trained, you have the advantage that you are one amongst the few who can do all this. But nowadays you almost have equally talented people, and there for every single stock you have hundreds of equally intelligent, equally talented people. Let's take all AMCs. They all pay their fund managers in crores, right? And globally, it's a very different scale altogether. So there's no debate that for one person to have a unique view or unique analytical edge over all the others is a very hard task, and especially to do it consistently over time. So which means you have to be extremely contrarian, or you need to pick those kind of bets which are very, very difficult to do it on a consistent basis. So this edge is also more or less done with. So the last edge is the behavioral edge, where people kind of do behavioral mistakes over and over again. And this is something that's held true for a long period of time. And my sense is hold true for a long time in the future. But the point is, to exploit this edge, you will have to have something which is non-consensus. So let's say the benchmarks are so and so. You need to have at least a very differentiated portfolio, which is what is measured by a metric called active share, which essentially says what is the portion of your portfolio which is different from your, because if you have the same portfolio, you can't outperform it, right? So one, you need to have something which is contrarian, so which means you create that differentiated portfolio. But the problem here is that you will either have dramatic outperformance or dramatic underperform, because net you are very different from the index. Now, a lot of people don't want to take this risk, because if you dramatically underperform, you lose the job. So most fund managers have kind of started becoming very close to, there is some differentiation, but still the active shares are very, very low, right? So this is a problem. And then on top of it, there is a cost angle where the costs are higher and compared to benchmark. So you put together the fact that your portfolios are almost similar. Nobody wants to take a a very differentiated bet, except for say a few fund managers. And on top of it, you have the costs which are coming down. And the third part, which a lot of us don't talk, is that net, what is passive? Passive fundamentally means bigger the better. You are essentially saying out of 100, 200, 300 stocks, I will just arrange them according to the larger size to lower size, and I will give a higher proportion of my money to the large. Now, instead of saying passive, if we say bigger is better, it's just a formula. There's no. So for this formula to work, the environment will also have to be in such a way that the bigger companies are doing extremely well. Now, if you look at the US market for the last 10 years, the bigger companies have done extremely well. So even in the index, the other companies have kind of underperformed the bigger companies. So one, the environment was favorable. Two, most fund managers were losing their edges, and nobody wants to take a very differentiated contrarian bet. And on top of it, the cost difference. So all these three put together is kind of leading to this problem. So my sense is at some point in time when the bigger gets better, I mean, bigger is better, kind of the environment favors, say, the smaller is better or higher quality, the better, or some other formula, then maybe there might be some more leeway for fund managers. But again, cost and the environment favoring bigger the better has been the predominant drivers. Now, putting it back to the Indian context, I think in large caps, it's very evident. Last 3 years, it's very, very evident, especially after 2018, where SEBI said that you are only allowed to 80% of your large cap fund should go into the top 100 stocks. The overlaps are insanely high. When we did the math, almost on an average, 60% of large cap funds portfolios mirror the underlying pool. So which means that you only have 40% which is differentiated. So for every 1% cost differential I have, I need to outperform by 2.5% on my 40% portfolio, because the remaining 60 is exactly the same. So if that 60% is going to go up 10, you will also get the same 10. So you can't different. So which means when we did the rough math, all funds will have to outperform by 5 to 6% year after year on that 40% differentiated portfolio. So which is why you are finding that large caps are struggling. So from an Indian context, we think that unless and until AMCs decide to, one, reduce the cost, two, create more differentiated portfolio, but otherwise most of the funds are between the 40, 45, 50% band. So unless and until this changes, my sense is, while you will obviously have 1 or 2 years where it will outperform, but the odds are insanely against the large cap segment. But on the other end, if you look at the small cap, you are still finding that a lot of fund managers are able to comfortably outperform, because almost every fund has a very differentiated portfolio. If you look at even between funds, the overlap is extremely low. So which means the universe is large, and there is also the informational edge, analytical edge, because there's not too many analysts looking at those segments, right? So the broad idea is that on one end, you have large caps in India where it's very difficult to, passive is becoming a better option. And on the lower end, you have active, which is the better. So, and then obviously you'll have flexi, mid, which are in between. Again, you can pick funds. And net, what do we finally need? We need only 4 or 5 funds, right? So you can still, I think still for flexi caps, mid caps and small caps, active still makes a lot of sense, provided you have the ability to analyze fund managers over long cycle, and you can blend styles together. So my sense is large caps from an Indian context is definitely more favorable towards passive, unless and until the expense ratios come down or the active share goes up. But at least for flexi cap, mid cap, and small caps, I still think we still have a long time before passive comes in. But eventually, I think mid caps will also become harder. But at least at this juncture, it looks like there is still a lot of opportunity, because net you need 4 funds, right? 4 or 5 funds. So you still have you can easily pick 4 or 5 funds which can still outperform. So for us, large caps has become passive. The other bucket, we generally use a style-based approach where we mix it across 4 styles from India and 1 global. So 4 styles would be quality, contrarian, growth at reasonable price, and mid cap bucket. Small cap is only for tactical. So under these, we pick one good active fund manager and put them together. And we've been running this from Jan 1st of 2020, which was the previous peak. And we have comfortably outperformed by close to 3%, 3-4% over the index. So that's kind of work. So I think there is still active fund managers. There is, I mean, if you pick the right funds, you can still comfortably outperform, is my sense.
Of late, we've seen, Arun, a lot of interest being generated, and you partly answered that earlier, into small caps. And this is, of course, a story which plays out every time a certain part of the market starts doing well. Even if one looks at Amphi data, there have been far more number of mid cap and small cap folios opened. I'm sure you have your own data. Uh, and yet there are commentators who are, all the time saying that, look, it's a high risk, reward kind of a game. When you look at small cap, you have to stay invested. Uh, how are you looking at the inflows that are coming in? Do you think they're healthy? Are people willing to stay on? Are they willing to have the appetite to take a sudden sharp fall as well? What's your sense of the way the small cap space is evolving?
See, historically, we've always seen this pattern repeat over a period of time, that whenever there is a particular segment of the market which does extremely well, be it small caps, or there's always some sector which does well, or there's a particular fund house which follows a particular. So let's say quality was a style which was in vogue, right? So all the fund houses which were on very good on quality, or had portfolios which were super focused on quality, they garnered significant amount of inflows in probably 2020 beginning, and then quality went through a bad time, and then now value funds are. So my sense is that going only by looking at the recent performance is not a good healthy thing, because and my sense is the recent inflows are mostly driven by what you saw in the last 1 year, especially the last 3-4 months is where the flows have started to significantly come up. Most of them are seeing the last 3-year performance, 5-year performance, and then you're seeing that the returns are very, very strong. But broadly, as small cap as a segment goes through cycles, right? So if you the earlier cycle started from 2013 until 18, you did really good, and then from 18 till 2020, you were almost down 50-60%. The index was down 60%, so most funds were down 40-50%. So it's a very volatile segment. Now, the other way we look at it is that we look at the intra-year falls every year. Right? Now, if you look at broad market of Sensex or Nifty, roughly the expectation is 10-20% falls happen almost every year. The last 43 years, except for 3 years where the fall was less than 10%, every other year you had a fall of more than 10. Mostly it's a 10-20% fall. Now, when it comes to small caps, the metric is slightly higher. You have to be okay with a 20-30% kind of a fall. Almost in 18 years, 11 years had a 20-30% kind of a fall. And the declines in that large falls, right? When you have a fall like 2020 or something like 2008, while the index might be down 50-60%, which in itself is painful, the small caps might be down 70-80%. So you need to be mentally okay with the fact that every year you will see far higher temporary declines, and in that large crash you will have a much higher fall, and most people give up during this. So which is why small caps have to be a very small portion, maybe say 10-15% of your portfolio, and again there you can either let it run over a long period of time, at least a 7-10 year time frame is required. SIP investors, it works brilliantly, because net you don't need to be worried about, because every time it falls, you end up accumulating more units. And even if it is at high like today, you don't need to worry, because you are not taking a call whether it's in a bubble or it's in a bull market, because net even if it goes up, you're still participating. So SIP investors, you have no problem if you are doing your small cap SIPs, and as long as you have a 7+ year time frame, you're good to go. But for normal investors, don't go overboard it. Let's say if you want 10-15% is your original allocation, don't make it 25 or 30. And this is not the time to make it 5 or say 10%. You are okay with the 50% thing. And I don't think it's a bubble kind of an environment, because if you look at the last 7-year returns, it is roughly around 12%, which is in line with Nifty. 12.5% is a precise number. And 15-year returns is still around 11.5%, which is again close to. So there's no bubble kind of a thing. And again, we look at a metric called a small cap as a portion of the entire market cap. That's roughly around 14.8. Usually 10 to 15 is the band it goes. Last time in 2017, and it went close to 18. So at 18, it becomes insanely expensive. And at 10, it becomes insanely cheap. So you're neither too cheap nor are you too So I think there may be some more legs to go in this, but broadly, this is not a time to go overweight or underweight, and don't chase the reason. If small cap was never a part of your portfolio, don't add it new, but if it was always 10-15% of your portfolio, then you can continue with the exposure. For SIP investors, there's no problem, absolutely. As long as you have at least a 7-year time frame, you should be good to go.
Arun, are investors staying longer in equity according to your own analysis of your customers or any other public data that you've looked at, which perhaps AMFI puts out? Or is there any indication that people are maturing, people are looking at equity as a long-term wealth building machine rather than a short-term trading machine?
I think the evidence in terms of why you need to stay long term is pretty clear, right? Because if you look at Nifty 50's total return index, roughly there is 80% of the times in the last 23 years is what we have the data for. 80% of the times you double in 7 years, right? And 70% of the times you triple in 10 years. So which means the odds are insanely by your side once you cross that 7-10 year. And usually the pattern that we have seen is that once investors cross the 5 to 7 year time frames, they tend to be invested a lot longer. Not because suddenly they won. Obviously, the odds are by your side. So most likely, 8 out of 10 times, you would have got a decent return. And two, the clear behavioral thing which happens is by then your profits are also high. Then the moment you want to sell, the tax component kind of hits you. And I've seen that most investors get really they get really angry, or whenever they see the tax component, nobody wants to pay tax, right? So which is why I've seen that once you cross the 7-10 years, most of them continue with the fund, and thereby they have a very, very good experience. So the challenge comes in the first 5 years, and there again I think the evidence is overwhelming that the time frames are coming down, both in terms of stocks as well as mutual funds. Now the reasons are very simple. Now you might think that during a market fall they will take out. So let's say as I told you, 10-20% falls are a given. The problem is every time there's a 10% fall, there is some bad news, and you don't know whether it is a 10% fall or is it a beginning of a 40-50% fall. So every time there's a 10% fall, people tend to extrapolate that, hey, this is the start of a 50% fall, so let me take out the money. So this is one mistake. And then let's say somebody sticks on and then continues. Even then there is like once in a while, like once every 7-10 years, there's a larger fall, right? Where most people kind of panic, say a 30%, 50%, 30, 40, 50% kind of a fall. So there they panic. And then the third, so at least these two are common things. One happens every year. One happens probably 7-10 years. But the third problem is that when the market goes up also, we see that people tend to come out, because every time it hits an all-time high, you get scared that, hey, I'm supposed to sell high. So you correlate the sell high with this all-time highs, and then you step out. So think about it. Every year when there is a 10-20% fall, you are worried that this is the big fall, and then you take out. And then every time there's a larger fall also, you take out the money. And when it goes up and hits the all-time high, and without hitting all-time highs, you can't get the whatever. Let's say you want 12%, means you are otherwise saying you want to double your money in 6 years. If you want to double, if index has to go from, say, let's say you take the previous all-time high of 60,000, it has to go to 1,20,000. Then from there, in the next 6 years, it has to go to 2,40,000. So while 2,40,000 looks a very high number, it's net 12% over 12 years, right? So the challenge here is that in all cases, people end up selling, and on top of it, there's this the products which underperform currently, and then you take out this, and then you move on to the another fund. So I think these are the reasons. But my sense is it's still a struggle for the first 3 years. Most investors tend to get a little jittery, but once you cross the 3-5 year time frame, then mostly they become long-term investors.
One of the categories you talked about, some of the other more equity specific categories, but one category which seems to have also done very well, and I'm asking this again from a retail investor entry point, is the balanced advantage, fund category, which is a hybrid, or you can call it a dynamic asset allocation. But is that a good way, according to you, for a beginner who's never invested to actually start wetting their feet, get a sense of what a mutual fund is? Or do you think if somebody is 22, 23, young, and more from your generation than mine, uh, can see, that I can stay for 10, 15 years, 20 years and build big wealth. Uh, what is your advice for a beginner?
Yeah. See, I think BAF definitely fits the bill for a first-time investor. So let's say you don't want to complicate it, but you want to get a sense of how to do equity investing. I think more or less, while you won't get equity like returns over long periods of time, but at least you will get some return which is probably between pure debt or fixed deposits and equity, but with slightly lower volatility. I'm not saying there won't be any temporary declines, because in COVID fall, while the index was probably down 40%, most balance advantage funds were still down 20-25%. So 20-25% is still a reasonable, it's like one fourth of your earnings, right? So, but it's a good starter category for somebody looking at investing in equity. And once you get comfortable, you can move on to pure equity funds. The other way to approach it for a beginner would be that level one should be that you just focus on increasing your savings rate, because net all said and done, whatever products that you pick, the return rates are not going to make an incrementally big difference, because you are starting off on a very small base. Probably once you cross your 40, when you look back, you know that, hey, that amount was insanely small, that I really did not need to break my head over. So I think the level one would be that get your savings rate high. Now, mostly people spend and say your savings rate is only 5%. Then don't worry about which is the next big sector fund or big fund to probably make it 10, make it 15, 20, 30. At least I think 30 should be a good enough target. I'm sure 30 is very difficult when you start off, because your salaries are low, your spendings are high, but eventually probably even 5, 10 is good, but get the habit in. So my sense is level one should be to focus on getting your savings rate at least as a percentage of your salary to at least 30. Obviously you'll start small, but that's fine. The second one would be that then how do you convert the savings into something which is easy enough for you to execute? Just split it into three buckets. I call it the 5-5-R strategy, which is 5% goes into your some liquid fund as an emergency. The other 5% goes into, say, a short-term fund, just for all your short-term expense, because like all said and done during your 20, 25 to like 35, inevitably there'll be a lot of stuff which happen. You might want to buy a car, there is a marriage which is coming, and then a lot of short-term expenses come, whether you like it or not. So another 5% goes there, and whatever remaining you can do. Let's say you do 20% as overall savings, the remaining would be 10%, right? That you can put it into a simple plain vanilla Nifty 50 passive index fund, and then begin off. And then for the first 2 lakhs, don't complicate. Just build it in a Nifty 50 index fund. Then maybe in the next 2 to 5 lakhs, you can probably add a mid cap index fund as well. Once you cross the 5 lakhs, by then you are probably 2, 3, 4 years in. Then you are reasonably accustomed, right? And then you can start looking at active funds. So I think if you follow this route, maybe you can straight away directly move on to equity funds, because you are anyway creating the buffer through an emergency fund at 5% and a short-term fund at 5%. So the 5-5 are all these 5% is as a percentage of your salary. So I think this can be a good way to start. And then eventually the third point is the most important thing is your salary. Unless and until your salary or income increases, very difficult to build wealth. All said and done, how much ever returns you get, you need this salary engine to also grow strongly over the first 10, 15 years. Eventually, over a period of time at 40s, while you build a large portfolio, then both of them contribute equally, like your savings and the returns from your portfolio incrementally add. But I think the early stage, it's only your salary which does the 80% of the burden is on your salary. So make sure that you focus on. So savings rate, the 5-5-R strategy, and then the third level is you obviously have to, for the big part of it really lies with you and not on the fund managers. Like you have to increase your salary.
It's been an absolute pleasure talking to you, Arun. Thank you so much for explaining things so nicely. I look forward to many more conversations. I do have a few of your research reports, which I will be putting out as small videos, because it's important that we get people like you from your generation to talk about concepts which keep changing, attitudes keep changing. But the most important thing is, yeah, as you rightly said, you can't rely only on your salary and let it take all the burden. You have to start investing as well. Small start, but keep at it. Thank you so much, Arun. Lovely talking to you.
Thanks a lot, Vivek.